Good afternoon, everyone. Today I'm chatting with Jordan Roy Byrne from The Daily Gold. In today's interview, we discuss why Jordan is bullish on gold. We get into how he thinks that we are entering a pretty bullish period for gold based on historic setups. And he gives us some of those price levels that we should be watching on silver that mean that it is game on for silver bulls. All right, everybody, enjoy the interview. Jordan, thanks for joining us.
Hey, Steve. Thanks for having me on. It's my pleasure to be on today.
So I was excited about this interview, and I apologize to the audience about the sound of my voice. I still wanted to move forward, even though I'm dealing with some a bit of a cold. But I thought we could start off maybe. I know that you've written a book that I believe is available for free on the internet about your gold thesis, and maybe we could start off talking a little bit about why you like gold, why you like this space, and kind of what brings you to the gold world.
Well, I'll try and give a quick intro, not ramble on too long. But I started investing when I was very young in the late 90s. Didn't know anything, of course. And I got very lucky. I got into tech stocks. And like any other neophyte, I was following stocks that were going up. So I was buying tech stocks on the way up. I got in early enough that I still made money after the bubble burst. And um, my problem was not so much the bursting of the bubble, it was buying these stocks, 30%, 50% off in 2001, thinking that, "Oh, this is some great buying opportunity, and they're gonna go right back up." And, of course, that didn't work out. Then after that, I got into technical analysis because I thought there really I knew that I would probably get into technical analysis eventually, but at that point, I thought there has to be a way to really figure out or explain why markets are making certain movements and when they're making those movements. And so I got into technical analysis then. Um, and at the same time, I had some people who were telling me, even at the height of the tech bubble, you should look into gold, you should look into resources. And I wasn't, I didn't agree with that at that point, but eventually, probably, I think 2002, maybe 2003, I had an epiphany and I thought, okay, all this stuff makes sense. We're going to have a huge bull market in resources. First, I went into energy, oil and natural gas stocks because they're making money and it's easy for me to understand. But at the same time, I was thinking I'm going to invest in gold and silver at some point. A little more difficult to understand because most of the smaller companies, they don't make money. But long story short, I got really lucky. I timed it perfectly, hit that '05 to '07 period, made good money after the bust in '08. But then after 2011, I wrote the first edition of my book. So this is really the third edition and the real best edition, I would say. Everything's finalized as far as my thinking. And so my thinking after 2011 was, um, so I wrote the first edition in 2015, and my overall macro thesis was wrong at that point, which um, I was thinking, okay, that we're gold is going to have another big run, like 76 to 80, and that's going to be it for gold. And stocks are not really in a new secular bull market, which was wrong. But in that first edition, I was right that precious metals and miners were so bombed out that they had to be at a major bottom. Just looking at comparing that bear market to other bear markets, looking at the valuations, just there's no way this is going to go lower. They're bombed out. Then a couple years after that, 2019, I wrote the second edition. I realized, okay, my big macro outlook has changed. The one I had in the first edition was wrong, but now this is looking like we're in a period very similar to the 1960s with the way gold stocks were performing. The stock market was still rising. And that's really been, I think, crystallized and confirmed with this latest edition where just the comparison to the 1960s, the mid to late 1960s now is just so perfect. There's so many things are lining up. From the second to the third edition, the big difference was the bond market and the secular bull ended. So we're in a secular bear for bonds now, which is a huge change because from 1920 to 2020, the only time you were losing money on bonds was about 1965 to 1982. So the secular bull in bonds ended, and so we're going into the second secular bear for bonds. Uh, only the second time in 100
So
years.
so so let me stop you right there just because I think
Sure.
our audience, they may wanna understand what that means. So when you say we're entering a bear market for bonds or we're in one, just for everybody who doesn't really understand what that means, that effectively just means interest rates are going up on bonds.
Exactly. So, yeah, so bond prices are going down, interest rates are going up. And when we're talking about secular trends, for the stock market, they're typically around 15 to 20 years, depending on how you measure. Now, bonds are different because we just got out of a secular bull in bonds that lasted 38 years. So bonds are a little different. Stocks and gold, or stocks and hard assets, they tend to alternate where one is in a secular bull, the other's in a secular bear. So one's going up, the other's going sideways for a long period of time. However, there are periods of overlap. There was some overlap in the 40s, there was some overlap in the 60s, and we're having an overlap again where you had gold breaking out of this 13-year super bullish cup and handle pattern last year, and the stock market is still rising, is still making higher highs at the same time. And so the only comparison for that historically is the mid 1960s. And the mid 1960s, you could not buy gold. So gold stocks, gold mining companies in the 1960s, they functioned as gold. So up until we had the gold ETFs in 2004, 2005, people who wanted gold exposure, they would just buy the miners in the large mining companies. So in the 1960s, gold stocks had this huge breakout in 1964, 65. They broke out of a 28-year base. And so I liken that breakout then to the one that we just had in gold, the cup and handle breakout a year ago. And so we're looking at, gold new all-time highs. The stock market's still making new all-time highs. Oh, and at the same time, the bond market is in a secular bear now, and it fell into a secular bear in 1965. So I'm looking at all these things from a 50,000-foot view. And so that's, as far as, because when I'm talking about my macro outlook, I'm really talking about what are markets doing at a 50,000-foot level? How are they interacting together? And so in recent years, money, of course, central bank buying has helped gold a lot, but 2022, we really broke and fell into a secular bear in bonds. So money has been moving out of bonds and into stocks and to a lesser degree gold. And so ultimately, the secular bull in the stock market, that's going to end at some, like, we're in the latter stages. I don't know if it's going to end in 2.5 years or 6 months or 9 months or 9 weeks or whatever. But looking at everything, and you can look at the charts and the data yourself in the book, you can see, okay, we're in the latter part of the secular bear, or excuse me, secular bull in the stock market. And so when that breaks and it eventually turns, as it did in the end of 1968, you're going to have the two major asset classes in secular bears as they were in the 1970s. And so that's a big reason why that bull market was super powerful.
So for our audience, your thesis is we're gonna enter a bear market for stocks. We're already in a bear market for bonds, which is gonna continue for some period of time. And when that sets up, that has historically been very good for gold.
Not only is it, will the secular bear for stocks help gold, as it did, because in the 2000s and the 1930s with gold mining stocks, bonds were still in a secular bull at those points. Yeah, let me say that again. So in the 1930s and the 2000s, you had secular bears in stocks, but not in bonds. So the only period where you had both stocks and bonds in a secular bear was the 1970s. So that's another reason why that secular bull in precious metals was especially powerful, which, by the way, began with the gold stocks in the early 1960s. So people look at that, oh, it was only a 10-year, it's only a 10-year bull market, but the gold stocks they actually went up for 20 years. They were moving up, well before gold. And silver, to a lesser degree, it did rise in the 1960s. But anyway, back to what you're talking about. Eventually, in the next few years, we're going to come into a point where secular trend in stocks and bonds down at the same time, which means the only thing that'll be in a secular uptrend, like the 1970s, will be gold and hard assets. And just one thing I'll add, by the way, which is a big point in the book, and this has changed in the last month. So the timing of doing this with you is really, really good. And so if we think about, gold put in this bottom in 2016 or 2018, it's been rising, and there's been, all this talk about, oh, well, what the stocks aren't doing that well, money isn't coming into the juniors. Like, what do we need? What do we need for this to perform better? What's the problem? Well, the problem has been too much money has been going into stocks, and so not enough capital has been moving into precious metals. And so technically, you explain that by looking at gold against the stock market, that relationship. And I have my own custom indicator. I threw bonds in there and created a 60-40 portfolio so you can get this historical data. And so I constructed a 60-40 portfolio, which is 60% stocks, 40% bonds. And so gold against that portfolio just broke out of a 10-year base in the last couple weeks. So this was basing for 10 years. It's breaking out in favor of gold. And also in recent weeks, gold against the stock market, as you may have seen, that broke out of a 4-year base. So that has been the big sea change in the last month, where I think people now are thinking in the last, well, this feels different. The stocks are starting to do better. Money is starting to flow into juniors. The reason for that is, not, I mean, one reason you could say, as far as the charts, is you look at these ratios. Gold has broken out against the 60-40 portfolio. Gold has broken out against the stock market. And so this has only happened a couple other times in the last 100 years. You have to go back to 1930, the end of 1971, the end of 2001, and this month. So those breakouts are important because they tell us, okay, money is now going to start moving out of stocks. And I mean, it's already happened in bonds to a bigger degree, but it's really, for the most part, stocks. So money is going to move out of conventional investments and stocks and into precious metals. And it doesn't always align perfectly every week or every month, but that's what we've seen in the last month. Like, you can look at these ratios, and gold is really strong in real terms, and we see more money coming into the equities, starting to come into the precious metal sector.
So effectively, what do you think the investor psychology is, that they just keep seeing stocks going down and bonds going down, and they're like, I've got to invest my money somewhere. I've got these two things that keep going down. Obviously, they're getting higher yield on bonds, so it should theoretically make them more attractive. But if we're in a bear market, they're losing money on their principal, um, at at least in inflationary terms or real terms. But why is it that they turn to precious metals?
Well, I mean, historically, there does tend to be some kind of link between people who invest in bonds, and when they see inflation, uh, they start to move a little bit of that money into gold, as we've seen in the last couple of years. But if we go back to the 60s, eventually, when you're in an inflationary period, of course, bonds break first. They lose it first. They lose the secular uptrend first. That eventually leads to the stock market falling into a secular bear. 65 is when the secular uptrend ended for bonds, and then late 68 for the S&P. Of course, the Dow in 1966. So stocks they were already slowing down in the mid 1960s. Like, money was already moving into precious metals. And uh by the way, if I mentioned 1971 was when we got that signal, but if you use gold stocks against the 60-40 portfolio, that really broke in favor of gold stocks in 1965. So we had that signal then, right along with bonds breaking, but the stock market still trended higher for a few more years. It didn't make the secular top until the end of 68. So we've seen the bonds have cracked as far as the secular uptrend. So that eventually will lead to stocks cracking. And so all these people who own bonds, which of course is a much, much larger market than stocks, people started pulling their money out of bonds, and they're putting it in stocks and gold. Maybe more of that's going into stocks so they can get the yield. A little bit of that is going into gold. because you still have the secular uptrend in stocks. So the way they've been looking at it the last couple of years, yeah, it's still rising. I'm still getting a good yield. I'm going to hold on to these blue dividend paying blue chip stocks. But eventually what happens is the secular bear in bonds and the inflation that's, pervasive, that eventually forces more money to come out of bonds. No, excuse me. That eventually forces money that went into stocks kind of as a defensive play against inflation. Eventually, that money is going to have to come out of stocks and go into hard assets and gold. So, I mean, I don't have exact figures or percentages, but we can look at these ratio charts and understand what's going on. So, just to kind of conclude my point on that. So, first, when the bond market breaks in an inflationary period, they're taking money out of bonds and they're putting a little bit of it into gold, but more of it into stocks. But eventually, the bear market in bonds, that impacts the economy. It impacts your debt payments, consumer spending, corporate all that stuff. So eventually that hurts stocks, the way it did at the end of the 1960s. And then that, those bondholders who put that money in stocks, that's going to start coming out of stocks and going into gold and other hard assets. So I hope that makes sense.
So obviously, this is the question you get asked whenever you kind of go and chat with guys like us, because it's what the audience kind of really just wants us to get down to, which is, have you mentioned any price targets or where you think gold could be heading over the next, say, couple of years?
Yeah, I do have some analog charts in the book where I compare um, the current move in gold to past cyclical moves. And looking at these analogs for gold, like they're actually pretty aggressive. Like even just an average move in gold, average real cyclical bull market move. I mean, gold could get to 5,000 in the next 12, 15, 18 months, something like that. So the targets I'm looking at, based on this, like they're kind of uncomfortably high. Now, to get to that point, you always have to think in your head as a technical analyst, like as far as the setup, like fundamentally, what is going to happen? That what's going to be the narrative for why there's more buying? Why the gold price keeps moving higher? And we'd probably need to see, I think, an economic downturn. I don't know if do we have stagflation where the economy kind of avoids a recession for a little while? But then inflation starts turning up again, and people are really nervous about that. I mean, you could have that, or you could have maybe at some point the economy peters out. We go into a recession. The Feds, they're going to have to cut, they're going to have to cut rates by 2% or something like that. I think either scenario right now, I think can drive gold significantly higher in the next year or two. As far as the cup and handle pattern, we did just reach the measured upside target, which is 3,000. So another target, and this is not, I would say it's rough. It's not as scientific as the measured upside target of 3,000. But if you look at the cup and handle pattern and you look at the, I call it the log target, where you look at the top of the cup and the depth, and then you take the percentage and you measure that forward, like that gives you 4,000. Like for example, 2,000 is the top of the cup, 1,000, you measure up, 2,000 minus 1,000, you add 1,000 to 2, that gives you 3,000, but 2,000, 1,000, okay, that's 100%. So you measure that higher, that gives you 4,000. And again, this is kind of rough because I've looked at other historical cup and handle patterns, which are not as perfect as the one, we just completed in gold. But those patterns went from the measured upside target, which is 3,000 for gold, to their log target in 6 to 12 months. So that would, based on that, that would tell us, we just hit 3,000 in the past few weeks, that we could hit $4,000 in the next 6 to 12 months. So I'm a little, you have that. And at the same time, I go back to my analog charts in the book. Um, if we get an economic downturn in the next year or two, I mean, it's a little uncomfortable to say, but I mean, the gold price could go to, 5,000 or a little bit higher than that. So we're in a new period because people are used to gold being smacked down. They're not used to being in a real bull market. that's lasted more than a year or two. So it's yeah, I mean, it's I don't want to come on here and sound like a cheerleader that gold's going to go much much higher, but I mean, it's very possible that the next few years we could see 5,000, 6,000, and probably silver break 50, and when it breaks 50, silver is going to run to 100. Probably within 15 to 18 months after breaking 50. And so just to drone on here about silver, silver has significant technical resistance right around 35, I think where we're at today. So 35, 37, and the quarter is coming up on Monday. So that's something I look at, what's the monthly close? What's the quarterly close? So if silver would close here, I think this could be the second or third highest quarterly close ever for silver. So again, looking at silver, 35 to 37, like that area of resistance, like that's really stiff. Like once silver surpasses 35, 37, like call it a monthly close or a weekly close, it's going to have much less resistance on its way to 50. And of course, when it gets to 50, there's blue sky. And we've just seen blue sky for gold. Gold broke past $2,100 an ounce a year ago. And so what happened for gold? Complete blue sky, just a steady move, 50% higher. But silver's problem is silver has been having to chew through all the resistance from 26, 28, 32. Now it's 35. So we're not quite there yet for silver, but eventually, I mean, if silver gets gets by $37 an ounce, I mean, it's getting pretty damn close to where there's just going to be so little selling pressure.
So it sounds like from your viewpoint here, if we're talking about silver, that level that we really want to watch here is $37. Once we get through there, we could be in a breakout. Do you have a number for gold where you think if gold gets through a certain level, it's game on?
No, unfortunately, I don't. I need to do more work on gold and specific targets. I mean, I'd have to look at Fibonacci levels, but the way I'm looking at it for gold is we just hit the measured upside target of 3,000. And so the log target is about 4,000. But beyond that, I don't have any like real analysis or way of you'd have to look at Fibonacci levels and Fibonacci sequences to come up with which that can work, but I have not looked at that. So I'm mostly focused, I would say, on 4,000, the log target, but I'm sure that there's Fibonacci targets in the 3,000s.
Okay, so Jordan, for our audience, if they want more of your commentary, where can they go to?
They can go to thedailygold.com. They can opt in there to get a copy of my book, PDF and an EPUB copy. I think it's a quick read. I do have there's like 100 charts in the book. There's a chapter summary at the end of every chapter. I also have a YouTube channel, The Daily Gold, um, on Twitter at The Daily Gold. So I post a lot of stuff on Twitter and my YouTube channel. And yeah, that's how you can find everything.
All right, well, Jordan, thanks very much for hopping on here. Maybe let's do this again after silver breaks $37 so that you could update us on what's going to happen next.
Happy to do it, Steve. Thank you so much for having me.
All right, everybody, thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let us know what you think in the comment section. Thanks, everyone.